The basis trade, a high-risk strategy putting the Treasury market at risk. Hedge funds have recently revived a high-risk trading strategy called the basis trade, which has the potential to cause a collapse in the entire Treasury market. The Bank of England has expressed concerns about the staggering growth of this trading strategy, as hedge funds have built up a massive leveraged position that is larger than it has been in the past decade. To understand the risks associated with this trade, it is important to grasp the foundational concepts of arbitrage, shorting, relative value trades, and being long an asset while simultaneously being short a derivative of the same asset. Arbitrage. Arbitrage refers to the simultaneous buying and selling of securities, currency, or commodities in different markets or in derivative forms, to take advantage of differing prices for the same asset. An easy way to understand this concept is through the example of garage sale flipping, where one buys an item for a low price and sells it for a higher price elsewhere. Shorting. Shorting involves selling a stock or security that one does not own, with the hope of buying it back at a lower price before the delivery time. This is achieved by borrowing the asset from someone else and returning it later. Relative value trades. Relative value trades seek to take advantage of price differences between related financial instruments by simultaneously buying and shorting different securities. This strategy aims to profit from the relative value of the two instruments, being long an asset and short a derivative. This concept involves simultaneously holding a long position in an asset while shorting a derivative of the same asset. For example, one may own shares of a stock while selling call options on those shares, giving someone else the right to buy the shares at a specified price. The basis trade and its risks. Hedge funds are using the basis trade to exploit discrepancies in the U.S. Treasuries market. They buy existing U.S. Treasuries and short the futures of those Treasuries, creating a relative value trade. The profit from these price differences is small, but hedge funds leverage their positions to multiply their bets. They borrow cash from the repo market, which poses a risk if repo rates increase or liquidity problems arise. The risks of unwinding the basis trade. If hedge funds are forced to unwind their basis trade positions, it can lead to a collapse in the Treasury market. This occurred in March 2020 during the dash for cash, when the Federal Reserve made emergency interest rate cuts. The lack of liquidity in the market and the need to close out positions can cause a chain reaction, forcing other hedge funds to unwind their trades as well. Potential solutions. To resolve a potential blow-up of the basis trade, the Federal Reserve could return to quantitative easing, QE, by buying off-the-run treasuries from the open market. This would provide an exit for hedge funds to unload their underwater treasuries. Another solution could be the U.S. Treasury, engaging in a Treasury buyback program, where they buy back existing debt using newly issued debt. However, both solutions would be viewed as bailouts and could lead to increased regulations on hedge funds. Conclusion. The basis trade poses a significant risk to the Treasury market, with hedge funds leveraging their positions and relying on short-term borrowing from the repo market. If this trade unravels, it can cause a collapse in the Treasury market and have implications for other financial markets. It is important for investors to be aware of these risks and construct their portfolios in a way that is robust against such disruptions. As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.